Hello, everyone. Sloane here. I'm the founder of Invest Vegan, and I am delighted to share with you our new kind of portfolio risk scoring framework, which I think will make a lot of the things that we do a little bit easier to understand for those of you who are not professional investors day to day. So before we get into this, I just kind of want to go through our standard disclaimer. This is not investment advice, right? Investment advice is something that happens once you've signed an agreement, you're working with us, we understand your situation, we can advise on it. This is sort of information only, right? So I'm sharing a lot of detail on the way that we invest in the hopes that it helps you understand how investments work and perhaps helps you understand whether or not you'd like to work with our firm. As just kind of a quick high level thing, our mission is relatively straightforward. We seek investment opportunities that avoid preventable harm to living things while making meaningful contributions to a better future for all, right? So avoiding preventable harm, that's what veganism is. We choose to avoid preventable harm to living things and making meaningful contributions, right? It's not enough to just not kill stuff. We try to find companies and opportonities that generate investment returns in the same way they generate impact. Um, this presentation is going to be, medium long. I think it'll be an interesting one. Get a sandwich, get comfy. We're going to talk about risk for most of this presentation in one way or another. So first, I'm going to give you some frameworks that you can use to begin to understand some of the personal dimensions of risk, right? Like, how should I, as a human, relate to this concept of risk, right? Then we're going to talk about some of the mechanical dimensions of risk, things that you're probably a little bit more familiar with, like inflation and market risk and so on and so forth. We're going to talk about the way that our investment strategies are constructed, the way that we combine them all together into portfolios, and what you can do with this as you move forward and walk away from this presentation and get on with your life. So yeah, personal dimensions of investment risk. And again, this is like really meant to help you have an understanding in your head of how investment risk relates to the things that you are trying to achieve in your human life. I'm a big advocate of this framework, which is not so often used and is a little counterintuitive to folks, but it's pretty simple when you think about it. Let's break your level of your risk, this big nebulous concept of risk, into three main buckets, right? You've got personal risk, which is the risk that you're not able to pay your bills this month, or kind of an emergency happens and you don't have any cash. In that bucket, investment return is secondary. You want to find safe assets that allow you to get on with your life and feel like you're insulated from these various risks. Like, what if you lose your job? Oh, great. I've got this personal risk bucket that I've invested for just that occasion. Then there's sort of a market risk bucket. And this is particularly relevant for folks who are, kind of retirees or, folks who are getting closer to retirement who might be thinking, well, I don't really want to take that much risk. I'm pretty old, whatever. The the market risk is what allows you to maintain your lifestyle over time. So having some exposure to the stock market, having some exposure to assets that balance risk and return or in a diversified portfolio, that's really the engine that allows your assets to keep growing over time, right? So we don't want to neglect that bucket. We don't want to, go and say, okay, well, we have enough money now, and we can sort of think about all the things we want to do for the next 5 years, and let's not think beyond that. That would be, in my view, foolish because it sort of neglects the long term, out of deference to a bunch of random stuff that probably won't seem that relevant to you in the future. And then there's the third bucket, which is aspirational risk. And this is something that I think most advisors, most investment firms neglect to discuss with their clients. Um, you know, I am a big believer in measured and manageable risks that have the opportunity to generate significant long term upside. And I think for most clients and most people, their personal risk posture can be concisely expressed as a combination of these three buckets, right? And let me show you what I'm talking about. So the personal risk basket is, again, um, really meant to protect you in the short term so that you can invest for the long term. I can't stress this enough. The magic of investing goes away if you have a short term personal crisis that requires you to sell your investments at an unopportune time. Things that are kind of like this, or that you might have seen in the past at other places or in previous lives, or you might just call this your emergency fund if you're not particularly a fan of thinking in terms of what investment strategies are called. You might call it your like a certificate of deposit, or you might have some I bonds which are designed to protect your assets against inflation. We have a sort of short-term reserve strategy that falls into this bucket here, that is managed for maximum preservation of capital. Then there's the market risk basket, where it's kind of more of a soup or a combination of things. And we have three of our four strategies can fall into this bucket depending on how much of the relative weights of them, and so on and so forth. But this is like where you might put like your ETFs, your mutual funds, your index funds, any exposure to a strategy that is likely to grow over time, likely to give you a decent return so that you can maintain your lifestyle as you kind of move through time. And then there's the aspirational risk bucket, which, the Invest Vegan ethical growth strategy is our flagship strategy. I put it in both here and our market risk strategy because it's appropriate for both, depending on the other things that are in your portfolio. But if you're used to talking to traditional advisors, you might think of things like private equity and hedge funds as being part of this aspirational risk bucket. If you're under the age of 35, you might think of crypto as being part of this, although I don't typically advise folks gamble with that. But in general, we're trying to kind of carve out a portion of the portfolio that is where we're really thinking about maximizing the upside, right? So if it's if you think about the whole portfolio, surely there's some piece, some part that might be sensible to expose to some true long-term risk in the hope of generating real long-term return. And I want to kind of talk through a couple of client personas to help you get a sense of how these things might stack up across different types of people, right? So if you're just starting out, your personal risk is a relatively small part of your life, right? Like you don't have that many fixed expenses. You probably don't have kids yet. You might have rent. You might have a car. But beyond that, it's not that it's not like there are that many other lives depending on you. And you can really, tilt yourself towards this aspirational risk, especially if you're saving in like Roth IRAs or other assets that, you're literally not going to be able to touch until you're 59 and a half, right? So if you're just out of college, you're maxing out your Roth IRA, you're 22, 23, think about that amount of time that you have between then and between the deposit and the, eventual withdrawal. You have some time to take some risk. As you start moving through your career, that sort of naturally, kind of changes a little bit, right? So, you get earlier career, maybe it's less aspirational, you have more personal risk, and you're starting to be a little bit more concerned with maintaining your lifestyle, right? So that causes us to tilt down a little bit on the risk spectrum. And then as you start to have, children and, maybe you might, pets, I think are actually kind of more common in the Invest Vegan client base than children. But, we start to kind of think about your dependents and the things that, you have to pay for no matter what, as we're building your portfolio, right? We're always asking, hey, would you be okay? Would you need this money? What are the odds that you're going to need this money suddenly? Because that allows us to identify, how much we can really afford to put in this aspirational risk bucket and how much we can put in these other kind of personal and market risk buckets. The last thing is sort of retirement, where I think in general, these buckets tend to equalize, but this is a highly personal thing, right? So some retirees will not like this is kind of this framework that I've shown here is the average, which may not actually apply to any individual human being, right? I think a lot of wealth management firms kind of use these frameworks and say, hey, this is the way that saving is, this is the way that life is. And it can be a little bit limiting because, not all clients fit neatly into these buckets, right? So, we hear a couple of other, kind of personas that, I kind of like to use, which I think, help explain the dimensionality and the depth of this framework, right? You might have, kids to feed, you're on a fixed income, maybe you're getting child support from a former spouse. Personal risk is strictly dominant, no matter what your age is, right? Personal risk is the most important thing. You want to make sure that you're not, leaving those mouths that you have to feed unfed. And then you may, have the ability to take some market risk and some aspirational risk. Then there's sort of the fraidy cat persona, which is a very real thing. And, there's nothing wrong with you if you are afraid of taking investment risk. It's like, this is your portfolio. It's your life. Our job is to help you, maximize the probability of success given who you are as a human being. So, I think let's not feel bad if we're looking at this and going, oh my God, 50% market risk, 80% aspirational risk. Gosh, Sloane is a nut job. I think though, even if you do fall into this persona where taking market risk is extremely scary to you, I would encourage you to think about, still dedicating a small portion of your portfolio to market and aspirational risk. In part because that's how you expose yourself to the magic of investing over the long term, right? So in personal risk bucket, it's unlikely we'll do much more than preserve the value of your funds after inflation. But if you are going to invest for, 5, 7, 10, 20 years, it gets more and more sensible to have some exposure to long-term investment risk. And then there are some people who come in and they're like, oh, okay, so the ethical growth strategy is the riskiest thing that you have. What else do you have? Can you make something riskier? You can call that sort of the giddy up persona. And, again, nothing wrong with that. We have plenty of clients for whom 100% of their portfolio is in our ethical growth strategy. This can be because the ethical growth strategy has greater control over the risks and opportunities that we are exposed to just because we're doing all of the stock selection ourselves. Or it can be because, folks are just kind of really interested in, that people understand themselves as true long-term investors that really want to expose themselves to 100% aspirational risk. That's totally fine. Again, our purpose, our mission is to talk about this stuff and help you understand it so that you can kind of self-identify and, we can have a more straightforward process of, building you the portfolio that best suits you. And then, there's this kind of relaxed returns persona where, you can sort of imagine somebody who's like, hey, I don't really want to take any of that lame market risk. I just want to hedge I want to be covered in the short term. And then I want to be long-term exposed to, the best and most thoughtful risks that I possibly can. That's valid too. Again, this scoring framework, this entire thing is just meant to be some loose parameters that we can use to help deliver the thing that best suits you. It's not meant to say, hey, here are the boxes, you better fit into one of them. So let's talk about the mechanical dimensions of risk. And, when I say mechanical, what I mean is like straightforward market forces that are easy to identify. And there are going to be a lot of charts in this section. So if you're a dork, get ready. Investment risk is really a spectrum. And I'm going to keep coming back to this topic throughout the course of this presentation because it's really, really important to internalize. But at first, I want to kind of, clarify that, the spectrum of investment risk is along this sort of compensation and severity, scales, right? So you don't necessarily get paid for taking every risk. And that's one of the most important things that we as investment advisors do is kind of pay attention to what the compensation is for taking a given risk and making sure that it's adequate relative to kind of what you might experience. And then there's also kind of the potential severity, right? So, for instance, if there's a liquidity shock, which means like, all of a sudden, things that you thought were liquid, things that you thought you were able to sell are actually very hard to sell. That's quite severe. But you don't really get compensated that much for taking it. Whereas, business risk, where, you're like investing in a given company and, you're very much exposed to the ebbs and flows and its fortunes, you get compensated quite a bit for that, right? Because if you wind up buying a stock and it does well, great. You can also experience quite a severe adverse, kind of thing if, we wind up putting you in businesses that, are not well considered. For simplicity's sake, I think, to be pedagogically accurate, I kind of threw interest rate credit and economic risk on here. But let's just lump them together as market risk, because I think for most clients, most people watching this presentation, the distinction is not super material. And, it's even kind of simpler to think about it as this kind of straight line spectrum, right? Where on the left-hand side, we have inflation, which is obviously scary, right? It eats your dollars if you're not paying attention. And on the right-hand side, we have business risk. So again, this is a spectrum. So, as we move along it, there's still some influence from other factors on the risk spectrum, but it's helpful to kind of think about, the difference between liquidity risk, where it's like, okay, we've bought some stuff and it's, like it generates a great yield and it's, helping me pay my day-to-day expenses, but it may or may not be the most liquid thing if you call us up on a Friday afternoon and say you want to sell it immediately. And then there's things like sequence risk, which is a little bit more, kind of harder to intuit, but basically it's the risk of what happens if you happen to get a bad series of years right before your goal. This is particularly relevant to retirees. And then market risk, which is, look, we choose to view market moodiness and market, volatility as an inevitability. I personally love it, right? And I don't mean I love it because, it means stocks go down or whatever. I love it because it means things are on sale. And so, as we run our monthly investment process, we can go in and buy, like discounted assets that we weren't previously able to buy. But on the client side, it's important to sort of remember that, like, you have to be able to make it through those cycles in order to experience the benefits of what we do, right? So we bring it up and we talk about it with clients so that, we're making sure not to catch anybody by surprise when the market has its inevitable sell-off or correction or whatever you want to call it. As you think about all of this stuff, one of the things that's kind of fun creatively to sort of leave with people is that all but one of these is kind of optional, right? You could sort of walk away from us or, have us manage it, but you could just sort of say, look, all I want to do is deal with inflation risk. All this liquidity, stock market risk, not for me. I would rather just, take my chances with certificates of deposit and see what happens. You can do that. It is what I would call a low percentage move for a variety of reasons. In part because you usually wind up, when you say, okay, all I want to do is, be exposed to inflation risk, you're kind of putting all your eggs in one basket a little bit. And there is a very real chance that, whatever we do for you, whatever you do for yourself somewhere else, it's only barely going to compensate for it, or it's not going to compensate rapidly enough for a big shift in inflation where, if you had, the more diversified portfolio with other sorts of contributors inside of it, there would have been enough sources of return to cover whatever inflation shock you're talking about. I hope that makes sense. But yeah, I mean, like it is like we do have clients who say, look, Sloane, I'm not a risk person. I want to just take as little as inflation risk and that's it. And we can do that. But a lot of the time, in our check-ins, one of the things that we're going to be talking about is, is this really what you want? Because, as a practical matter, taking, just inflate, exposing yourself to just inflation really sets yourself up for some pretty muted outcomes down the line. This is kind of a messy chart, but like what it shows you is inflation across a whole bunch of different countries across a whole bunch of across the last 20 years or so. And like I want to call out that many of us have different experiences of inflation, right? Especially folks who grew up outside of the United States, right? People who grew up in Turkey or Argentina experience inflation as like this tidal force that just shows up and completely eliminates the value of their assets. In some cases, folks will even go to the grocery stores in the morning so that the price changes in the afternoon, so they can beat the price hikes in the afternoon, right? In the U.S., in the eurozone, inflation has been substantially more muted than that over time, right? We tend to assume it's going to be 3% or less in our thinking over the long term, by which I mean 10 years. So, a 10-year average will be 3%. But it's important to note that extremes happen. Especially as you look across the spectrum of countries, right? Like New Zealand has had, an inflation rate that's compounded at 6.5% over the last 20 years. Singapore has had an inflation rate that's compounded 8.5% over the last 20 years. Argentina, 20% over the last 20 years. But we're not Argentinian investors. We're not Singaporean investors. We're American investors. And so as a result of that, we wind up experiencing, a much more muted historical trend. With that said, inflation still grew an average of 10% a year in the US and Eurozone over the last 10 years. This is a chart that just sort of shows on the bottom, the 10-year compound average change in inflation, and on the left axis, the 1-year change in inflation, right? So you have Argentina way out on the far right with, all sorts of crazy experiences with inflation. The Eurozone and the EU, again, even though we've had this 10%, compounded annual rate of growth in inflation, still among the most muted, kind of experiences with inflation. So, what's our guidance? What do we say that you should do about inflation risk? The first thing I would say is just to be careful that you don't trick yourself and avoid false safety, right? Avoiding all of the other risks and just concentrating on inflation will cap your upside without a guarantee of protection. So if you're really interested in that, that's, an environment where we may refer you to somebody who can write you an annuity or something like that. And, kind of just say, hey, thanks for, stay part of the community, but we're not the best investment manager for you. That said, there's no sense taking risk with your short-term safety holdings, right? Your emergency fund, cash you'll spend soon, that should be ultra safe. And I actually, had a formative experience in the stock market. I inherited a portfolio from someone else that was full of short-term investments that were quite high risk, and I dealt firsthand with the fallout of that. So you can sort of trust us to be a little bit careful about that on your behalf, as you can, in general. But again, the thing that I'm going to keep coming back to here is that your emotional reality, the way that you feel about the risks that you're exposed to, should be your main guide, right? There's no like quantitative, perfect portfolio for you. The perfect portfolio for you is the one that doesn't keep you up at night and that has the highest statistical probability of meeting your goals. And again, the assets that are most directly exposed to inflation, you should think of them as, as there to help you feel safe while investing elsewhere for the long term, right? So the inflation sensitive assets, or the assets that are, kind of the least risky, the reason they're there is so that if the market sells off and you lose your job and you need to pay your mortgage, you have something to draw on without selling your stocks. Because, as a practical matter, at those times, it will usually be the best time to buy stocks rather than sell them. And you would likely, if you had to sell stocks, experience a haircut on them. Uh, Liquidity risk is a tricky thing, and it's something that a lot of advisors don't really talk about with retail clients. I think it can be helpful because it sort of makes clear that, first of all, that we're thinking about these things and that we're incorporating them into our asset allocation process. Oh, cool! Little thumbs up. But beyond that, it can make the sort of nebulous and scary concept of a liquidity crisis a little bit more manageable, having shown you a bunch of ones that we've actually lived through. So the financial crisis is sort of the big one in terms of liquidity crisis. That's where I started my career and had the sort of fallout of a riskier than it should have been portfolio that someone else designed that I had to deal with. It really makes everything else look tiny in comparison, right? So this is a sort of a couple of indices of financial conditions and financial stress. They are really good indicators of banks' willingness to lend, which is a really good indicator of how easy it is to sell and buy things in the market, how available capital is for things. In the financial crisis, it really was the case that the market froze for months. And if you were in a position where you wanted to sell your stuff, tough luck. The subsequent crises that we had, the European debt crisis, in the early 2011s, 2012s, Brexit and the Trump election, the onset of COVID, the Silicon Valley Bank failure, really, we did have sharp increases in financial stress over a period of months, but in magnitude, they really were not anywhere near the stresses in the financial crisis. And these indicators get less relevant when you go back further than this because the markets have changed so much, and you don't want to use a modern indicator on an archaic market. But we design our strategies to withstand this, right? We are always picking our stocks, picking our companies, picking our funds with this idea in mind that there may be a sudden shock, and we want to make sure that the company doesn't need to raise funds overnight and have some scary thing happen, or like the quality of the assets is such that we would be comfortable riding through one of these periods without being able to sell. As a practical matter, I usually buy things kind of prepared to own it for a very long time. And so, the best defense against a liquidity crisis is owning things that you actually want to own. And the part of that relates to our work together, if you're an Invest Vegan client, is making sure that the things in your portfolio, or that your portfolio is really designed in a way that suits you. So that if we do have this kind of inevitable period of financial stress, you're not going to be in a position where A, it catches you by surprise, B, your life and livelihood are adversely affected by the fallout of this liquidity crunch. Recent experiences in liquidity crises have been mostly focused on, or mostly centered on, China, cryptocurrency, and within a couple of highly leveraged companies. Part of this is because the Fed and the European Central Bank and other macroprudential regulators also lived through the financial crisis and are very much focused on not allowing a repeat. So you could say that they're kind of really attentive to these risks, but in general, liquidity crunches have happened in very, very risky assets, and to a to an asset. I mean, we have some companies that have some leverage, but we have no crypto. We have very little exposure to China. You know, the we are paying attention to where liquidity crunches are happening and using that as sort of an indicator of whether or not we want to participate in them. Um, you know, the biggest way to protect yourself from a liquidity crunch is not to borrow to invest, right? Not to borrow money, put it in the stock market, and see what happens. That is literally gambling. We do not advise it. We do not enable it. I'm sure you could if you wanted to figure out a way to do it, but don't. You won't be great. You won't be happy you did. So we avoid companies that borrow to invest. That's true both at the individual company level. We want to make sure that companies aren't like taking out loans in order to pay their dividends, because that's just risky. And we're also checking in with clients about their near-term liquidity needs, right? When we see, folks taking withdrawals, we're going to check in and say, hey, should we augment your portfolio to make sure that you have a little bit more liquidity, or is this kind of a one-off thing? At the individual holding level, and this is stuff that we do more than stuff that our clients will do. Um, we're always looking and saying, okay, so if this company couldn't access the capital markets for a year, would they be okay? Would they need to? Are they going to need to raise money soon? And if so, scary. It's one of these things where it's not rocket science, but it's also not something that tends to be foregrounded in a lot of client portfolios, especially ones around ESG and sustainability, where that are often put together by marketing folks and not investment people. The other thing is don't buy things on a whim, right? Like we see these liquidity crunches as opportunities. I want you to picture me, it's almost like, I feel almost like I'm going to my favorite thrift store with a 90% off sale happening and like not that many other people there every time there's a liquidity crisis or a liquidity issue in the market. By maintaining that discipline and being really, kind of programmatic about the way that we interact with the market, we're able to treat these situations as opportunities rather than big scary eventualities, right? The other thing, another risk that I think investors really should be paying attention to is sequence risk. Now, this is the kind of the risk that there's a sudden financial shock that eliminates years of investment returns in a portfolio that's not been that well constructed. And what we have here is a portfolio of real estate securities going into the Great Recession and the financial crisis. Right? There's a period here of a couple of months where that portfolio has a 100% downturn, or decline. Right. So, or loses, kind of basically all of the gains that it made to over a decade to, just this sudden risk that, whoever was building this portfolio should have been aware of and should have been protecting the portfolio from. The purple line here is just a straightforward bond portfolio, right? So, you might say slow and steady wins the race on the back of this, but I think really the lesson here is that the construction of your portfolio really matters, right? It's not enough to just have a line that goes up. You want to make sure that that either you or someone else is checking in on a periodic basis to make sure that you don't have just one risk that is responsible for substantially all of your returns, as is the case in this kind of real estate portfolio. The way that we, kind of approach this and manage this is diversification. We, in general, are always checking in with clients about the reality of this and working with them to manage it and, kind of make sure that as their lives change, as their situations change, we're accounting for those changes in the way that their portfolios are constructed. So in some cases that might look like incorporating, other, managers, other funds or strategies into our portfolios to kind of help mitigate the volatility of our ethical growth strategy. In some cases, that might be, kind of keeping some money in, cash equivalents or, whatever. It really depends on the client. But the important thing is that, we emphasize this checking in process, right? If you have a year of good returns from us, I guarantee you're going to get a note that says, how would you feel if you lost money instead of gained it? And let's talk about the next couple of years. Let's just make sure that this posture that we have is still right for you. Market risk, is the most straightforward, the most, I think, wonderful risk out there. I am a big believer that market risk is worth taking for clients that are willing and able to withstand it. And the reason why is relatively straightforward. If you look at this chart at the right hand side that has market returns over the last kind of 40 years, right? This is the Wilshire 5000, Wilshire Real Estate, and Nasdaq, which are tech stocks. To save on money, we don't have the fancy, and we don't have the S&P 500 as as an index available going back that far. But if one does take market risk over the long term, it does work out in their favor. A 3-year time horizon historically has been long enough to experience positive returns most of the time. So this is those same 3 indices, and the circled areas are the periods where you had, on a 3-year trailing basis, you had a negative return. The first is the S&L crisis, the savings and loan crisis in the late 1980s, where a lot of banks went bankrupt, and you just had a lot of volatility. This was sort of also after the great crash in 1987. The tech bubble burst right here, the tech bubble burst right here when the tech bubble burst, and you had periods of low returns. Then the housing bubble, you had some short periods of kind of negative returns. But I think it's remarkable how infrequent these periods of negative returns really are, right? Like, think about it. This is a 40-year view of the stock market, and I can only point to like 2, 3, 4 years where if you were invested for 3 years, you would have been worse off as a result of it. That's remarkable. And I think that it just kind of further speaks to the reason that we stress this long-term posture. It gets even more straightforward when you hold for 10 plus years, right? So these bubbles are the same kind of periods as the earlier slide, but only the housing bubble creates a 10-year period where returns are negative. So again, if you're holding for 10 plus years, if you're invested for the long term, whatever the market does today, whatever the sell-off is today, is basically trivia. And you should really view any sell-off as an opportunity to invest. I know that's not the way that we're wired necessarily, but that is the way that the evidence suggests we act. Our job is to help you and our clients take a balanced approach to market risk, right? So we're calibrating portfolios on a continuous basis, and then also instituting guardrails where, if a client comes to us and says, hey, I want to take a ton of risk, seek other investment counsel. That's not really something that we do. Our posture is to, really focus on organic sources of return, which most straightforwardly are investing for the long term. It's a phenomenal defense against market risk if you're able to do it. And I'm going to keep saying that until I turn blue in the face. Business risk, I think, is a really interesting one. This is the risk that a given company can experience headwinds that negatively affect the portfolio. Most people wouldn't think of this, but I'm quick to say that our ethical screening process is one of our most powerful defenses against this. We screen out literally thousands of companies for all sorts of reasons. If they're doing oil and gas extraction, they're manufacturing weapons, they're emitting too much, on and on down the line. These are the top 5 reasons that we've excluded, and the number of companies that we've excluded for those reasons as of November. We've excluded more since then. It's January now at the time of filming, but in general, I'm very, very rarely, I can count on one hand the number of companies that I've excluded for an ethical reason where I was like, that was going to generate some positive returns. That was a high quality company. Just think about it. Like most dairy farms are not great companies, right? Show me a dairy farmer that's having a great time, and I'll eat a shoe. Um, Once we've kind of eliminated those companies that are taking, that are just extremely risky from my standpoint, we then kind of score companies on a variety of factors and update that score, right? So, this matrix here is the number is a, sort of a set of things that feed into our scoring process. It's not everything that feeds into our scoring process. We've had instances where, we just sort of thought that we've uncovered that a company is lying to us, and that obviously plays into our scoring process. We've had instances where, we just like think that a company is, that we can't for the life of us understand how the company is going to generate returns for shareholders. That plays into our scoring process. We are at a high level, though, what I want to leave with you is that we are continuously looking at every company we have not excluded that we could plausibly include in our strategies to, make sure that our portfolios reflect the best combination of companies across, a wide variety of factors. This is, by the way, my favorite thing to do, and you can keep me away. You can pry me away from this with, like my cold dead hands or something like that. I don't know. But this process is at the very heart of how we invest. And it is something that I cannot imagine doing any other way. The holistic process of evaluating risk and opportunities and risk is, again, at the center of how we think about this. Once we've kind of swept everything out that's poorly run, it's unethical, we're then able to think about how do we integrate with sustainable economic and social systems? How do we optimize this process for cumulative learning so that we're, always paying attention to, kind of what we think are the most interesting set of opportunities? It's not perfect. We will make mistakes, I guarantee it. But hopefully, by revisiting those decisions every month, those mistakes won't linger for long. Now let's get to our investment strategies, which I think is what a lot of people think about as kind of like the most important part. I think the client is the most important part of this whole thing, but I'm just going to talk about kind of the four components that we use to build a diversified portfolio. Across the spectrum, there's, kind of the short-term reserves portfolio, which, again, we are just investing for stability and security, right? We want the dollar that you've invested in this to stay a dollar. And we want to generate some yield, but that is secondary. Then there's this impact and income strategy where we're lending money longer term, generating higher yield, and experiencing a little bit of liquidity risk as a trade-off for that, right? So, as distinct from the short-term reserve strategy, which is basically fancy cash, the impact and income strategy, really is fixed income, right? It is it is something that can be a long-term part of your portfolio, and like it, but the corollary for that is that it's not something that I would advise, tossing, some money that you absolutely positively need next month into. Then there's this sort of external equity portfolio, which is purpose-built to diversify our ethical growth strategy. So like ethical growth is our flagship strategy. It's the one that we market to institutional investors. It's the one that, is kind of my heart song, at a high level, right? It's the purest output of our research process. And the external equity strategy is designed to, diversify some of the risks and make it so that, the ethical growth strategy can still form, sensibly form the core of a more conservative investor's portfolio. Again, short-term reserves, the safest and most liquid assets that are consistent with our ethical framework. Might be ETFs, might be mutual funds. it depends on, on the market, on what's happening. But the best outcome here is to slightly outperform inflation, right? That would be a home run. So again, I want to stress that the short-term reserves portfolio, is would be an interesting choice for 100% of your assets. And the only portfolio that we have that where it's the dominant exposure is the lowest end of our risk spectrum among our portfolios. Then there's the impact and income portfolio, which is a mix of closed-end funds, ETFs, mutual funds, preferred stocks, real estate investment trusts, anything that produces income. We're generally looking for components of this strategy to lend money to community projects, to companies, to countries. A lot of times this can be like loans to schools, loans to to various municipalities. Whoop! Oh no, what have I done? Loans to various municipalities. This is something that could be sensibly used on its own. It is not as risky to sort of base a portfolio around this only. It's slightly more risky than the short-term reserves portfolio because literally anything would be. But it's still designed to balance risk, deliver income, precipitate positive impact. Then there's a sort of external equity portfolio, which I would not advise using without the ethical growth portfolio. It's a mix of externally managed funds, ETFs, mutual funds. The drawback of this strategy is that the ethical controls are not implemented here. So there may be companies inside of these strategies that do animal testing, or that are selling customer data in ways that we don't like. All sorts of things. Like our risk screening, our ethical risk screening process is about as stringent as exists, I believe, on the streets. So it's difficult to imagine that another firm would be able to do exactly the same thing. But for clients that are more sensitive to kind of the short-term vagaries of the market, who have goals in the next 5 to 10 years, say, it makes sense to think about including some of that. First, because across the external equity portfolio, you might own thousands of individual stocks, right? So it's a very diversified portfolio. So the impact of any given company is relatively small. And B, pretty much no matter what, the ethical growth portfolio is still going to be the most material source of return and risk in your strategy or in your portfolio. It may be the case that, one of the things that I like about the external equity portfolio, though, is that it allows us to buy and diversify into places like Japan, where we can't buy that many locally traded companies because they're just not available to U.S. Investors and as individual stocks. But if we use an external manager, we can access those opportunities. So, you might call this making lemonade out of lemons. I think of it as doing what our clients need. The ethical growth portfolio, again, my heart song, our flagship strategy. Performance, positions, and other statistics are on our website. This is a concentrated portfolio, extremely low turnover, right? Like the other day I thought that I had gone in and taken a weed whacker to this portfolio, and I wound up selling only about 3 or 4% of the holdings, right? 67% of the holdings have been held since inception in September 2021. So it's a good fit for folks who are sensitive to taxes, because just holding for the long term is one of the best defenses against tax bills. It's extremely flexible. You can think about it as, hey Sloane, here's some money, go do your best. And thematically, right now, it's exposed, kind of in equal portions to innovation, to infrastructure, to kind of lending of various kinds, and to real estate. When I think about innovation, that's everything from Elf Beauty, which is which makes the makeup that I'm wearing right now, to ASML, which makes the machines that make every high-end semiconductor on the planet. Now let's talk about our portfolio design framework, which you might think of as putting this all together. Um, we are all, whenever you go in on our website and complete one of our questionnaires, we're going to be scoring you on two components: your willingness and your ability to accept financial risk, right? The components of like your willingness is going to be a function of your emotional state, how long you have to invest, how experienced you are. Your ability is going to be a function of how likely you are to need these monies. Do you have other money available? Do you have, are you, unable to accept, the trade-offs that come from the external equity portfolio? Um, we're going to generate an initial assessment, but one of the things that I always stress with clients is that it's a starting point. We haven't, come up with some magical questionnaire that, is able to tell you the truth of who you are as an investor. What we do instead is identify a starting point that we can then work from iteratively to, get your portfolio closer and closer and closer to where it should be over time, right? And the better part of the work that we do together with clients is to check in and make sure that, things are the way that they should be. So again, this our initial, kind of client risk scores is just a starting point. You can kind of think about them as falling, like this across the risk spectrum. We score from 1 to 10, and that sort of allows us to have a little bit of granularity here where, there's like 1, which is, just the short-term reserves portfolio. And then kind of like the difference between 1 and 2 is more substantial, is pretty substantial. 2 and 3, pretty substantial difference. 3 and 4, pretty substantial difference. But then as we get higher up in the scores, the differences between the levels start to be less substantial. They start to be, kind of more, about relative shades of exposure. And, it's not necessarily the case that the most risky portfolio will have the highest return over time, right? Like the 10 is, just the ethical growth portfolio. And statistically speaking, the most likely, kind of portfolio to generate the highest returns over time would be more diversified. With that said, even though the chance of the ethical growth portfolio outperforming is relatively low, we're going to still do our darndest to, kind of generate some really interesting and exciting returns there. But I want to show you again an illustration of risk as a spectrum, right? Because I think the way that I've explored this and explained this over the course of this video can leave you kind of thinking that, like maybe like portfolio 3 is only exposed to liquidity risk and that's it. So, here we have this kind of gradient that shows you how much market risk is, observable in each of these portfolios. And you can kind of see intuitively that it's a spectrum, right? Even, some of the least risky portfolios still are colored a little bit by the market because we can't, transport ourselves to another planet. Risk truly is a spectrum. And, it's not, it would be foolish for us to say that we can, wholly design our way out of it. But by talking about it, by putting it forward, and, helping our clients understand how it relates to their goals, we can help them make sure that we're calibrating that level of risk appropriately. So let's talk about some of the strategies that we discussed earlier, right? The starting out, person might be a 9 or a 10 on the risk spectrum, where, someone who's more balanced, later in retirement and kind of more interested in, being kind of evenly postured across the risk spectrum, would be a 4 or a 5. And again, those life stages are not the whole story when it comes to, your individual level of risk and your ideal level of risk, right? If you're, kind of aligning with our kids to feed persona, you might be a 2 or a 3, even if you're literally 23 years old. Or if you're a fraidy cat, again, you might be a 1 or a 2, even if you're 23 years old. Obviously the giddy up persona, I think, is self-explanatory. The relaxed return persona, I think, hopefully is somewhat self-explanatory. Let's show you how, like, what's actually inside of these portfolios so that you have a sense of what's going into them. And then, we can get on to next steps and I can shut the heck up. I think, the one is, again, just our short-term reserves, right? But as you move up the risk spectrum within this kind of value preservation thing, the amount of the portfolio that's devoted to short-term reserves declines. So in one, it's 100% of the portfolio. In two, it's only about 40%. And then in three, it's 20%. What fills in the balance? Well, the impact and income strategy winds up being the predominant replacement, for it. So, you'll have in both of those cases, 40% of the portfolio will be in that impact and income strategy. And then, as you start to be able to be willing to take a little bit more risk inside of the value preservation, sleeve of risk buckets, we start to add more of our ethical growth strategy and the external equity strategy. Because, look, even though we have some stocks in the portfolio, the overall level of risk in these portfolios is still quite low. Because, if you think about this three portfolio, that's 60% is going to be in fixed income and short-term reserves. So if you do have a short-term need for cash, you can draw on those assets and, kind of leave these, kind of longer term investment assets to grow and compound for you. You'll notice as you go across the risk spectrum, the ethical growth portfolio is a larger and larger component of the portfolio's composition. And that's because, we love our own cooking. It's a great strategy. And, it makes sense for clients that are able to take longer and longer term risk to have a greater and greater proportion of that long-term growth strategy. The external equity, is a little bit more variable, in part because, you might have, if you have a client who's a 6 on the risk spectrum, they might be, in the situation where, they want to kind of have a balance between, covering their short-term needs and investing for the long term. And the external equity strategy sort of operates as a shock absorber, if you will, as you kind of move, kind of closer in, right? So it's a little bit, that's a little bit more confusing, but I assure you there's thought behind it. And then the impact and income strategy, will be, kind of the most material part of portfolios in the 3, 4, 5s, and then kind of slowly declining as you get into the higher risks levels. Something to just point out is that, if you're a riskier person, it might still make sense to have some exposure to the impact and income strategy because, if we do experience a downturn, we can expect that downturn to affect the impact and income strategy less than the ethical growth strategy. And so that may give us the opportunity to invest more into equities later on at a great valuation. Next steps. You'll be glad to hear that we're getting to the end of this presentation. If you're not a client yet and you want to kind of go through the process of getting to know us and working with us, the easiest way to do that is to click the Get Started button, which is very easy to find on any of our web pages. That will take you through a kind of onboarding process that gathers stuff like your name and address. But it will also take you through the risk profiler, which will assess your willingness and ability to bear risk and help you, and help us kind of begin a dialogue about how to design your portfolio. If you are a client, what I want you to do, and you've heard this from me already, is pay attention to how your portfolio is making you feel, right? If it's making you feel nothing at all, cool, that's awesome. But is it keeping you up at night? If so, tell me immediately. Because my goal is to check in with all of our clients about annually when we send them a performance report and say, hey, this is how you've done. How does it sit with you? What do you think? What's going on in your life? But I want to stress that we're here whenever you have questions or concerns. So the fact that we're not going to necessarily reach out more than annually doesn't mean that you should feel like we're not interested in talking to you. And with that, that's about it for me. I think I am so grateful to you for spending this hour with me. Pretty cool that it wound up being exactly an hour. Please don't be a stranger. My email is sloane@investvegan.org. You can reach out directly on our homepage, or leave a comment underneath this. Please, you know, don't be a stranger, and don't hesitate to share anything that's confusing, because, you know, I think my biggest concern as an investment professional is that I have a tendency to talk up here when clients really want answers down here. So I apologize retroactively if I've done that in this presentation, and I hope that you will bear with me. Thank you again. Mwah. Bye.